Hi there, it's Vince Mohr, your mortgage professional up and down the state of California and beyond. And today in this video, I'd like to just go over or recap the home loan process. And in subsequent videos, I'm going to go over just the different loan products and terms that are available to you. The best place to always start in the home loan process is to find a loan officer that you feel comfortable working with. And there are different types of entities and loan officers that work for each of those different types of entities. The first being a commercial bank and or a credit union. The next would be a mortgage bank, where they lend their own money. They are a bank, but the only thing that they do are home loans. And then the third would be a broker, someone that brokers loans or is the middleman for the other two entities that I had mentioned. Plus, they have the ability to do hard money loans and commercial loans and a few other things that a typical loan officer wouldn't be able to offer. But anyways, today we're going to talk about home loans, single family to 4 units. After you've interviewed some loan officers and you have someone that you feel comfortable working with, the next thing to do is to get pre-approved, especially if you're in the purchase market. It's not so critical with refinancing because you have not unlimited time, but you have typically more time. But on a purchase, you want to get pre-approved because you want to know how much you can qualify for, how much your budget is. So when you go out and start making offers, you can confidently make those offers and give a pre-approval letter to your prospective prospective sellers, just that you'd be able to qualify for this loan. Remember, there's a difference between getting pre-approved and pre-qualified. With the pre-qualification, you can pretty much do that just over the phone, giving the loan officer your information and making sure that that information is correct, because of course garbage in, garbage out, but they're not really necessarily going through the steps of getting you pre-approved or getting you approved like with the pre-approval. With the pre-approval, you're going to need to provide all of the documentation that you normally would for a regular approval. The only difference is that you don't have a property, so you're going to need to we'll go over right now the 3 C's. Actually, there's 4, but they call it the 3 C's of underwriting. The first C would be collateral, the property, and this is the one item that the one area or of the C's that you would not have under the guise of a pre-approval. So, but with the collateral or with the property, of course, they're gonna you're going to come up with, based on what you're qualified for, come up with a loan to value, and then they'll run an appraisal. Your lender will or broker will have an appraisal run to determine the value of the property and what the true loan to value of the property is going to be. And then also they'll run a preliminary title report with the title company, just to make sure that the title's clear and that you're not buying a place that you're going to ultimately end up owning with ma and pa kettle. The next is capacity. Your income or your debt to income ratio, and this you will go ahead and provide your lender or broker the information. That would be typically a couple of years tax returns, a couple of years W-2s, pay stubs covering at least a 30-day period. If you're self-employed, getting a year-to-date profit and loss, just to show that if you're, if they're averaging your last 2 years federal income tax returns, just that your business is still earning at least the same amount of money that it had been or averaged for the last couple years or more. So that would be the capacity. The next would be credit, and actually that is something that you could do with a pre-qualification as well. If you give enough information to your loan officer, they can go ahead and legally pull your credit. And then they'll typically follow up with a borrower authorization, just that you gave permission to run the credit. But again, after collecting so much information, there's 6 different items, and then we can legally pull your credit. But again, what we're looking for is your FICO scores. Each of the different loan programs that we'll talk about in subsequent videos actually, breaks down based on The program is broken down based on your credit scores and where those fall. And then the final C is capital. So your down payment. You know, how much money are you going to be working with as far as the not only the down payment, and that's of course going to determine part of your LTV, which we've already talked about, your loan to value ratio, but also your closing costs. You know, and prepaids if you decide, or you're required to have impound account for property taxes and homeowners insurance. But that's usually verified by 60 days, a couple months worth of bank statements. If the account happens to be, you know, they issue quarterly statements, then of course getting just getting one statement because it'll cover 3 months. That kind of goes over the loan process. There's certainly more to it. We can go into each of those areas in greater detail with future videos. But if you've enjoyed this video, I ask you to please subscribe, like, and share. And if I could assist you or someone you know with a home loan, please keep me in mind. I wish you all the best. Thank you.